Imagine a company hitting the accelerator. I mean, really flooring it, growing at breakneck speed, expanding into new territories, building this empire. It sounds exhilarating, right?
Absolutely. It's the dream for a lot of businesses.
But what if that speed comes with a significant cost? What if they're burning through cash faster than they earn it, almost like a high-performance engine, running really low on fuel?
Yeah, that's the flip side, the danger zone.
Well, today we're diving into exactly that kind of story. We're looking at DADelo SA, that's DADELO SA, ticker DAD.WAR, over on the Warsaw Stock Exchange.
That's right. Datalo is expanding incredibly quickly, an e-commerce native retailer.
Right, e-commerce first.
Exactly, specializing in, bikes, parts, accessories, the whole cycling world, really.
And primarily in Poland, yeah.
Primarily focused on the Polish market, yes.
Yeah.
And they're a fascinating, but also, complex case study and growth strategy.
Definitely complex. It seems to combine this really aggressive expansion with some very real and I think increasingly pressing financial challenges.
That's the core tension we're seeing.
So our mission in this deep dive is to go beyond the headlines. We want to really unpack the intricate investment analysis of DADelo SA.
Yeah, get into the weeds a bit.
Exactly. We're going to reveal the truly bullish potential, their unique market consolidation strategy, that innovative omnichannel model they have. It's genuinely interesting.
It is. There's a lot to like on the strategic side.
But, and this is a big but, we also need to confront the significant bearish risks, the risks tied to that aggressive, very cash-intensive expansion.
Can't ignore those.
Nope. So we'll be pulling from, a stack of articles, research, our own analysis, basically trying to extract the most important nuggets of knowledge for you to help you understand this dynamic interplay between, ambition and financial reality that Datelo just perfectly embodies.
Absolutely. At its core, Datelo represents that classic investment dichotomy, doesn't it? The thrill of high growth versus the inherent dangers of high risk.
That's it exactly.
And the central question we'll be exploring today, I think, is whether their impressive, almost hyperspeed revenue growth can truly translate into sustainable profitability. And, maybe most crucially, consistent positive free cash flow over the long term.
Right, because that's where the rubber meets the road for any company expanding this fast, isn't it? Can they actually fund their own growth from operations, or are they constantly, reaching for outside capital?
That's the fundamental question.
Okay, let's unpack this then. Let's start with really understanding who Datelo SA actually is, because their origins are, they're genuinely unique.
They are. It's not your typical startup story.
No. Picture a modern, digitally first player in the vibrant world of cycling. Not just selling bikes, but trying to create this whole ecosystem around them.
Right. Focus squarely on bicycles, parts, all the accessories a cyclist could possibly want.
And their main playground is the Polish market, which is pretty dynamic itself.
It is. But here's the real kicker, the strategic advantage that really sets them apart. Datelo isn't just some startup that began in a garage somewhere.
No, far from it.
Precisely. Datelo is a majority-owned subsidiary of Oponeo.pl SA. Now, Oponeo is an established e-commerce leader in Poland.
Yeah, they're big in tires, auto parts. People know them.
Exactly.
Yeah.
And this parentage, this sort of strategic incubation, gave Datelo a head start that, frankly, most young companies could only dream of.
So how did that actually come about, the structure?
Well, their corporate history goes back to 2005, headquartered in Big Gus, Poland. But that crucial relationship with Oponeo.pl, it was formalized back in April 2016. It was a joint venture with another company, CCR Sport SPZOO.
Okay, who were they?
CCR Sport was already a key player in the online bicycle trade. So Oponeo.pl took a controlling 58.83% stake, and the whole idea was explicitly designed to combine Oponeo's deep financial capacity and their extensive e-commerce experience.
Right, their know-how.
With CCR's specialized industry knowledge in cycling and their existing market position. Kind of the best of both worlds.
That makes a lot of sense. And it obviously paid off because Datelo then went public on the Warsaw Stock Exchange, the TPW, in December 2020.
It did. And what's truly fascinating here, I think, is how Datelo effectively inherited what you could call a best-in-class operational backbone.
Right, explain that. Like, they didn't have to build it all themselves.
Exactly. Think of it this way. Instead of starting from scratch building a house brick by painful brick, Datelo basically moved into a fully furnished, state-of-the-art mansion.
Well, nice analogy.
They bypass years of incredibly costly and, let's be honest, high-risk infrastructure development. Things like advanced logistics, seamless fulfillment systems, robust IT platforms.
All the stuff that takes ages and burns cash for a startup.
Precisely, and this allowed them to immediately focus their precious capital and management resources directly on the stuff that faces the customer. Aggressive marketing campaigns, expanding their inventory selection, optimizing the customer experience.
Which basically turbocharged their scaling and market share gains right from day one.
It gave them an advantage few companies ever get. A monumental competitive edge, really.
Okay, so that's the foundation. What about their core strategy now? You mentioned omni-channel.
Yes, a sophisticated omni-channel model.
Okay.
So at its heart, their business is anchored by their dominant online platform, DAD.WAR.
Which is a big name in Polish cycling e-commerce, right?
It is widely recognized as one of the largest and most dynamic players. They also operate the DAD.PL domain, so they have this comprehensive digital storefront.
But they don't stop online. They're also building out physical stores.
That's right, a rapidly burgeoning network of brick-and-mortar showrooms. Key locations already up and running in major cities like Warsaw, Wrocław, Gdańsk, and they've got more planned on the horizon.
And these aren't just your average bike shops, are they? This is where the omni part really comes in.
No, definitely not average. These physical stores are absolutely crucial to their strategy. They're designed to create these powerful synergies with their online channel.
How so? Like click and collect?
Exactly. They offer convenient click-and-collect services. So you seamlessly blend online purchasing with immediate in-store access if you want your stuff right away.
Makes sense. What else?
They also leverage some pretty cutting-edge in-store tech, like NFC tags and QR codes on the bikes.
Ah, so you can just tap your phone.
Right. Instantly access the full range of online product info, reviews, specs, everything right there on your smartphone while you're looking at the physical bike. It bridges that information gap between online and offline.
Okay, that's clever. And I heard something about test tracks.
Yes. And talk about experiential retail. This is where they really try to differentiate themselves. Some stores even have dedicated in-store cycle tracks, complete with, like, little obstacles.
Seriously?
In the store.
Yeah, so you can actually test ride different bikes, maybe a mountain bike on a simulated rocky bit, or a city bike over some pretend cobbles right there.
Wow. That's a tangible try-before-you-buy experience that, pure e-commerce just can't replicate, especially for something expensive like a bike. Crucial for high-ticket items. Plus, these showrooms provide those essential professional services, repairs, maintenance, expert advice. That helps build long-term customer relationships, that go way beyond just one sale.
Builds trust, loyalty. Okay, I get it.
So this dual integrated approach, it's all underpinned by some seriously impressive operational excellence.
Like their logistics.
Yeah, their logistics and fulfillment capabilities are, frankly, on a massive scale.
Yeah.
They operate from 17,500 square meters of warehouse space.
That's huge. Like what, 3 football fields?
Roughly, yeah. And it's supported by highly automated shipping processes, dedicated professional bicycle assembly stations, the whole 9 yards.
And what does that translate to in terms of orders?
This setup gives them the capacity to process an astonishing up to 5,500 orders per day.
5,500 a day.
And get this, an impressive 95% of those orders are delivered within 24 hours.
Okay, that level of efficiency and speed, that's a massive competitive advantage in e-commerce, especially for bulky things like bikes.
It really is.
And how do they manage the tech side? Is that outsourced?
No, it's all powered by their proprietary IT and technology. They use in-house IT solutions, and crucially, they leverage the extensive, long-standing experience of developers from the wider Oponeo.pl group.
Ah, tapping into the parent company's resources again.
Exactly. This ensures they have a modern, secure infrastructure, and they're constantly working to optimize that digital user experience, from browsing right through to checkout.
Makes sense. And what about getting the word out? Marketing?
They're not shy about marketing either. Their brand building uses this multi-pronged approach. It intelligently blends digital reach with community engagement.
So what does that involve? Paid ads?
Yes. Performance-based digital advertising like SEM campaigns, the search engine marketing, bidding to appear high in search results, but also long-term organic search optimization, SEO, making sure their site naturally ranks well.
Content marketing too. Blogs, videos.
Definitely. They invest heavily in content marketing. They have a popular blog, a dynamic YouTube channel. It serves both to inform cyclists and, well, entertain them.
Building a community almost.
Precisely.
Yeah.
And what's more, they've built a really significant social media presence. Over 100,000 cycling enthusiasts following them across different platforms. They're effectively fostering this vibrant community around the Dadelo brand.
Okay, so massive operational backbone, strong digital presence, slick marketing. But what about the actual products, the bikes and gear themselves?
Right, the core offering. They boast a truly comprehensive range. Over 85,000 carefully selected SKUs.
SKUs, stock keeping units, unique product codes.
Exactly. Over 85,000 of them from 520 top brands. This covers pretty much everything you can think of. Robust mountain bikes, cutting-edge e-bikes, reliable cross bikes, stylish city bikes, even BMX.
Full spectrum.
Plus, an extensive selection of parts, accessories, specialized cycling apparel. It really is a cyclist's paradise trying to cater to every possible niche.
And didn't I read something about their own brands, private labels?
Yes. And here's a particularly smart strategic move, both for product differentiation and, critically, for achieving higher gross profit margins. Dadelo is actively developing and marketing its own in-house private label brands.
Like which ones?
Their most notable one is called Oxfeld. It specifically focuses on tourist and sports bicycles.
Ah, okay. And why is that smart? Better margins.
Exactly. This strategy gives them much greater control over the product design, the branding, the quality, and most importantly, the profitability. By bypassing those third-party brand markups, they can capture significantly more value themselves.
Got it. So, putting this all together, what does it mean for their market position?
It suggests they're not just, selling bikes online. They're strategically building this integrated high-volume operation designed to dominate the market. And they're looking very carefully at maximizing every single aspect of their value chain, from sourcing right through to the final customer experience, including those higher-margin own brands.
Okay, so now we understand Dadelo's pretty formidable foundation and their strategy. Let's talk about the actual terrain they're riding on. The Polish bicycle market itself, it sounds like it's a big market.
It is. It's large and active, no doubt. Valued at an estimated PLN 4.9 billion. That's roughly 1.15 billion in 2024. So significant scale.
But you mentioned it's changing, not straightforward.
Not straightforward at all. It's undergoing a pretty significant structural transformation. There are definitely bumps in the road, creating both, opportunities and challenges for players like Dadelo.
Like what specifically?
Well, we're currently seeing this period of post-pandemic normalization. While the market is substantial in value, the actual number of bikes being sold, the unit sales, are declining from their pandemic-induced peak.
So the COVID bike boom is over.
Pretty much, yeah. Unit sales hit a high of 1.46 million bicycles sold back in 2021. The projection for 2024 is down to 1.21 million.
So a noticeable drop, fewer physical bikes being sold each year.
Definitely. It indicates a contraction after that extraordinary demand surge during the pandemic where, everyone suddenly wanted a bike.
Okay, but here's the fascinating part, almost counterintuitive. You said fewer units sold, yet the market's overall value is still growing. How does that work?
Right. This is supported by a rising average selling price, the ASP. It was around PLN 3,800 per new bicycle in 2023.
So people are buying fewer bikes, but more expensive ones. What's driving that?
It's really attributable to two main factors working together. First, you've got general inflationary pressures, which we're seeing everywhere, right? Driving up costs and prices across the board.
Sure, inflation's hitting everything.
But maybe more significantly, there's a really profound shift happening in the product mix. A shift towards higher-priced electric bicycles, e-bikes.
Ah, okay. This brings us to the e-bike revolution. This really is the biggest tailwind for the market then, isn't it?
It's the ultimate growth catalyst, absolutely. The true game changer for the entire industry right now. We've seen truly explosive growth in this segment, and it's fundamentally altering the landscape for companies like Dadelo.
How big is the shift?
Well, think about this. The e-bike share of the total market grew from just 16% back in 2020 to a really substantial 25% in 2023.
Wow, a quarter of the market already.
And that 25% represents a standalone market value of approximately PLN 1.25 billion. Projections suggest this share could increase even further, potentially hitting 28% by 2026.
So it's not just a fad, it's a structural shift.
Exactly. Higher value e-bikes are driving the overall market's financial growth, even while traditional non-electric bike sales might be softening.
And isn't there talk of government help, subsidies? That could really pour fuel on the fire.
There is potential for that, yes. A future boost could come from the possible introduction of a government subsidy program. It's tentatively named Modrower Elektricny, which basically translates to My Electric Bicycle.
Like we've seen in other European countries.
Exactly. Similar programs elsewhere have had a massive impact on adoption rates. But here's the double-edged sword.
Got a cost.
Right, that high upfront cost for e-bikes, it remains a significant barrier for many Polish consumers. So while the demand is definitely there, and you might get government support, that price tag is still a hurdle.
Which raises an important question. How is DAD.WAR positioning itself to specifically leverage this e-bike shift, especially given those, financial dynamics and the potential subsidy? Are they all in on e-bikes?
They're clearly positioning themselves right at the forefront of this shift. You can see it in their inventory mix, their marketing. It's heavily weighted towards e-bikes. They know that's where the value growth is.
Okay. Now, what about the competition? Who else is playing in this Polish bike market?
Well, the Polish retail market generally is quite fragmented.
Yeah.
But in bikes, you have some major players. There's Cross SA, who are actually the traditional domestic market leader. They have an estimated 25% market share, producing something like 1 million bicycles annually. So big incumbent.
Cross, okay. Anyone else?
Then you have broader retail players who aren't exclusively focused on bikes, but have dipped their toes in. Like the big footwear and apparel giant CCC.SA, they now sell some bikes. And even Auto Partner SA, an auto parts distributor. It shows how varied the competition is.
Right. But here's where DAD.WAR's story gets really compelling, isn't it? Because while the overall market is shrinking in units sold, DAD.WAR is posting truly exceptional revenue growth. We're talking 48% growth in 2024 and an even higher 58% in the first half of 2024 alone.
That divergence is absolutely key.
It's not just keeping pace. It clearly indicates they're actively, aggressively consolidating market share. They must be taking it from those smaller, maybe less sophisticated, less well-capitalized competitors.
That's exactly what seems to be happening. They're not just going with the flow, they're actively reshaping the flow. They're thriving where others are struggling, carving out a much bigger piece of slightly shrinking pie in unit terms.
So they're the consolidator.
They are. And actually, challenging industry conditions like this, they often create a favorable environment for the strong, agile players in the long run. As smaller guys struggle with, say, inventory bloat or price pressures or less efficient operations, DAD.WAR can leverage its scale, its inherited best-in-class logistics, that strong financial backing from Oponeo.pl, and to basically vacuum up market share. They position themselves to emerge as a dominant force when the market eventually stabilizes or recovers. It's a classic survival of the fittest scenario playing out.
Makes perfect sense. They have the infrastructure, the backing, the financial muscle to absorb the shocks better than smaller players.
Precisely.
But it's not all smooth sailing, is it? Not all tailwinds pushing them forward. You mentioned headwinds, bumps in the road.
Yes, some significant industry headwinds that could potentially derail even a strong player like DAD.WAR. That post-pandemic hangover we talked about. It just means a tougher environment for organic growth across the board. Consumers likely made their big bike purchases already.
Right, demand pulled forward.
Exactly. And perhaps a more critical near-term risk, one that could profoundly impact profitability for everyone, is the potential for massive oversupply and really intense price wars.
The inventory issue again, but market-wide this time.
Yes. DAD.WAR's own CEO has explicitly voiced significant concerns about what he called a najazdom, basically an invasion of unsold bicycles flooding in from severely overstocked Western European markets. He specifically mentioned Germany.
So retailers in Germany ordered too many bikes during the boom, and now they need to dump them cheap.
That's the fear. If these surplus bikes get dumped onto the Polish market at heavily discounted prices, it could trigger a brutal, intense price competition. And that would mean severe pressure on gross margins across the entire industry, including DAD.WAR.
So even if DAD.WAR keeps growing sales, their profit per bike could plummet.
Precisely. This isn't just a hypothetical risk. It's a very real threat that management is clearly worried about.
And that potential price war, it's probably compounded by the fact that Polish consumers are generally quite price sensitive, right? More so than in, say, Germany.
That's another key factor, yes. Despite that premiumization trend with e-bikes, Polish consumers are still relatively price-sensitive compared to their Western European counterparts. You see a really robust secondary market for used bicycles, for example. And generally, the average selling prices in Poland are lower.
Which limits DAD.WAR's pricing power.
It does, and it would exacerbate the impact of any potential price war. So yes, they're consolidating, they're well-equipped operationally, but the battlefield itself is getting tougher. Profitability could definitely suffer, even if they keep growing those impressive sales numbers.
All right, let's buckle up then because we're moving on to the financials. And looking at .WAR SA's numbers, it really does feel like a financial roller coaster.
That's a good way to put it.
You see this tale of two very different, almost contradictory trends playing out. On one hand, you have the spectacular revenue surge, just incredible growth.
Hypergrowth, really.
Mm.
On the top line, revenue grew at a staggering 44.6% compound annual growth rate, CAGR. The average annual growth over several years from fiscal 2020 to fiscal 2024.
Wow, 44.6% CAGR.
Yeah, reaching over PLN 280 million in revenue in fiscal 2024. That's an incredible achievement, showing immense market capture, no doubt about it.
But on the other hand, you have this extreme, almost white-knuckle profitability volatility. That amazing growth isn't translating smoothly to the bottom line, is it?
No, it absolutely isn't. It's creating a very bumpy ride for anyone watching the stock.
Hmm?
Take gross margins, for example. They contracted really sharply from 30.5% in 2022 down to a quite concerning 27.4% in 2023.
Ouch. Why was that? Competitive pressure? Dumping stock?
Most likely a combination of those competitive pressures we just discussed, maybe needing to clear some slower-moving inventory at lower prices. It's hard to say exactly from the outside.
Did they recover?
They did recover strongly, back up to 31.8% in 2024, but that volatility flowed directly down to their operating margin.
How bad did it get there?
Operating margins basically collapsed. They fell to just 0.2% in 2023, barely breaking even at the operating level.
0.2%. Wow.
Then they rebounded strongly to 5.4% in 2024. But this extreme swing, and you from almost zero operating profit to a decent recovery, it really highlights the operational risks inherent in their rapid expansion and that intense competitive environment.
Yeah, it shows how sensitive their profits are to even small shifts in pricing or costs.
Exactly. Very sensitive.
And this rapid expansion, it hasn't just hit the income statement, has it? It's put a truly significant strain on their balance sheet, too.
Oh, absolutely. Their total assets more than doubled in just a few years. From PLN 110 million at the end of 2021 to over PLN 237 million by the end of 2024.
That's a lot of growth, a lot of investment, building up the business.
It is. But here's the kicker, the part that should really raise an eyebrow.
Liabilities.
Total liabilities increased nearly 20-fold over that same period, from just PLN 6.3 million up to almost PLN 120 million.
20-fold. Okay, that's dramatic. A huge expansion on both sides of the balance sheet. It clearly indicates a heavy reliance on external funding, right? Debt or supplier credit.
It truly does. And the primary driver of this massive balance sheet expansion, the real elephant in the warehouse, if you will, is inventory.
Back to the inventory. How bad is it?
Inventory levels just surged from about PLN 61 million at year-end 2021 to over PLN 173 million at year-end 2024.
Tripled almost.
Pretty much. And this trend didn't stop. It continued into 2025, reaching a staggering PLN 216 million by the end of the first quarter. That's an increase of over 80% year over year for Q1.
Okay, wait. Over 80% inventory growth year over year. How does that compare to revenue growth in that period?
That's the critical point. This inventory growth is significantly outpacing revenue growth.
That's not good. That's not just strategic stocking for growth then.
No, it's signaling a major inventory management challenge. Think of it like this. Every single zloty tied up in inventory is a zloty that can't be used for anything else. Paying suppliers, investing in stores, R&D, anything. It's essentially cash frozen in goods sitting in a warehouse.
And if those goods don't sell quickly?
It becomes a massive drag on the business. Risk of obsolescence, write-downs, discounting, it's dangerous.
So we have hypergrowth in revenue, impressive top-line numbers, yes. But underneath, there's this massive and frankly disproportionate inventory buildup.
Right.
Which brings us to what I was calling the cash flow paradox. Because despite reporting net profits on the income statement in most years,
which looks good on the surface,
DAD.WAR has consistently failed to generate positive cash flow from its core operations. That's a critical disconnect, isn't it?
And this, for me, this is the most critical aspect of their entire financial profile right now. It's the Achilles heel in their growth story.
Why is operating cash flow negative?
Operating cash flow was negative PLN 13.3 million in 2022 and negative PLN 13.3 million again in 2024. This isn't just some accounting quirk. It's a direct consequence of their working capital dynamics. Primarily, that ever-growing mountain of inventory.
So the cash from profits is just getting sucked straight into buying more stock.
Entirely consumed, and then some. The cash generated from profits is being completely swallowed up, plus more, by the need to fund that continually expanding pile of inventory.
Which creates this challenging, almost dangerous paradox.
Exactly. The faster Dadelo grows its sales, the more cash it actually burns through in operations.
That's a really, really tough spot to be in. It reminds me of some of those .com bubble companies, like pets.com, amazing revenue growth, but they just burned through cash so fast funding that growth, they eventually imploded.
It's a classic pattern for unsustainable growth.
So this operational cash burn, plus they're spending money on capital expenditures, right? Building those new stores.
Yes, that too. We saw negative investing cash flow of PLN 11.6 million in 2024, mainly for those store investments and logistics upgrades.
So burning cash in operations, spending cash on investments, where's the money coming from?
It means Dadelo relies heavily on external financing to plug the gap. They had a net inflow of PLN 37.1 million from financing activities in 2024, mostly debt, presumably.
So this whole dynamic growth being funded by external capital rather than internal cash generation, that's just not sustainable long term, is it? Not without a clear, definitive path to positive free cash flow.
It absolutely isn't sustainable indefinitely. It's like building a taller and taller skyscraper. But you can only pay the construction crew by constantly taking out new, bigger loans rather than actually collecting enough rent from the tenants already inside. Eventually, something has to give.
Can we quantify this strain? Are there ratios that show this pressure building?
Yes. We can look at some key financial ratios to see this clearly. Their current ratio, for instance. That measures a company's ability to pay off its short-term liabilities with its short-term assets. Basically, it's short-term liquidity.
Okay, what happened there?
It declined sharply. It went from a very, very healthy 25.28 back in 2021, indicating immense liquidity, loads of assets compared to liabilities.
Right, super safe then.
Down to a much more modest 1.78 in 2024.
1.78. Okay, that's still above 1, which is often seen as a benchmark, but
But the dramatic drop is what's telling. It reflects a rapid increase in their short-term liabilities. Things like accounts payable money owed to suppliers relative to their current assets, especially cash and receivables. It indicates a significant tightening of their liquidity position.
okay, that's concerning. What about debt levels?
What's even more telling, maybe even alarming, is the debt-to-equity ratio.
How did that change?
It exploded. It went from a very conservative, very low 6.1% in 2021
Tiny amount of debt relative to equity.
to an alarming 101.6% in 2024.
Wow, over 100% debt to equity. So more debt than equity on the balance sheet now.
Essentially, yes. That indicates a fundamental and really rapid shift in their capital structure towards significantly higher leverage, higher financial risk.
Okay, let's just pause and unpack this. What does this all mean for you, the listener, when you're looking at growth companies, seeing these kinds of numbers?
Well, it means that while that top-line revenue growth is absolutely exciting, it captures the headlines, gets people interested, it is far, far from the whole story.
You have to look under the hood.
You absolutely have to look under the hood. The balance sheet and, crucially, the cash flow statement, these tell you if that growth is actually healthy and sustainable, or if the company's maybe building a beautiful house of cards that could just topple under the slightest financial pressure.
So a company can look like a rocket ship on the income statement.
Exactly. But if its cash flow from operations is consistently negative and its debt is piling up like you're seeing here, it's a huge signal to dig much, much deeper.
It reminds you that growth at any cost often comes with a very steep and sometimes, well, fatal price tag down the line.
Precisely. Building right on that point, Dadelo's management, they aren't shying away from their ambition despite these financial pressures. In fact, you could argue they're doubling down.
Full speed ahead.
Full speed ahead. They're pursuing a very clear, very aggressive growth strategy, focused on solidifying their market leadership position in Poland first, and then eventually expanding internationally.
And the core of that strategy is still the omni-channel approach.
Yes, their central pillar remains omnichannel dominance. That deep integration of their strong e-commerce platform with a growing physical retail network. Management clearly believes this isn't just about having multiple sales channels. They see it as the key to capturing the entire market, offering a superior end-to-end customer experience.
And building a moat.
And ultimately building a durable, lasting competitive moat that makes it incredibly difficult for rivals, especially pure online players or traditional bike shops, to compete effectively. They want to own that customer journey, online and offline.
And we see that commitment in their store rollout, right? They're moving fast on that.
They really are moving fast with that aggressive retail rollout. Following the successful launches in Warsaw back in April 2023 and then Rokar in February 2024, they have a third major showroom planned for Gdańsk, targeting early 2025.
So they're not just talking about it. It clearly demonstrates their commitment to deploying significant capital towards this strategic initiative. They're physically making it happen across major Polish cities.
Absolutely. Which is, let's be clear, a massive undertaking. It comes with all the operational complexities of finding prime real estate, staffing these stores, managing local market nuances. It's not easy or cheap.
No. And they're looking beyond Poland, too.
Indeed. They're not stopping at Poland's borders. Management has signaled their clear intent for international ambitions. They're actually targeting the opening of their very first foreign store sometime in 2026.
Okay, that's a big step.
It represents a significant, yet highly complex, next step in the company's growth trajectory. International expansion, however, it undoubtedly introduces a whole new layer of operational complexities, regulatory hurdles, logistical challenges, cultural differences.
Things that can prove really capital intensive.
And distracting from management if it's not executed flawlessly. It's a huge leap to go from national dominance to establishing an international presence. A lot can go wrong.
So this massive vision, omni-channel dominance in Poland, international expansion, how are they framing this financially? Have they set targets?
They have. And to fuel this aggressive vision, they've set some incredibly ambitious financial targets for themselves. For the full year 2024, for instance, they were aiming for a staggering 50% increase in revenue.
50% on top of already high growth.
Exactly. While simultaneously aspiring to restore their gross margins back to that 27% level they saw dip in 2023, which is a tough ask. Grow massively and improve margins.
Yeah, those often work against each other. What about longer term?
Even more ambitiously, the long-term aspirational goal, stated publicly by the CEO, is to reach PLN 1 billion in annual revenue.
1 billion zloty. Wow. That's a truly bold vision for a company of their current size.
It really is. It requires them to continue those exceptional market share gains, capitalize heavily on market trends like e-bikes. Basically, everything needs to go right.
But given that financial tightrope we discussed, the cash burn, the debt, how realistic are these targets really? And how are they planning to pay for all this ambition?
Well, those ambitious targets naturally bring us right back to the cost of that ambition and how they plan to fund this future. Their capital allocation policy right now is entirely geared towards funding these aggressive growth plans. There's minimal focus on immediate shareholder returns at this stage.
So reinvest everything.
Virtually all capital generated, and then some, as we saw with the negative cash flow, is being reinvested straight back into the business. The primary uses of cash are funding those large, continually growing working capital requirements, especially that expanding inventory, and financing the significant capital expenditures for the new physical stores and upgrades to their logistics. It's a classic reinvestment-heavy growth model.
Which explains their dividend policy, or lack thereof.
Exactly. They don't have a regular dividend policy, which, to be fair, is not uncommon for high-growth companies like this.
Did they ever pay one?
They paid a small dividend, just PLN 0.15 per share, back in 2022 for the 2021 fiscal year. But nothing in 2023 or 2024, and frankly, no payments are anticipated in the near future.
Because they need the cash.
Given their negative free cash flow and those insatiable reinvestment needs, it makes perfect sense that dividends are firmly on the back burner. They need every single zloty for growth.
It's a very clear signal. Growth is the absolute overriding priority right now.
Absolutely. And crucially, to fund this persistent cash deficit, DAD.WAR is increasingly turning to the debt markets.
We saw that in the debt-to-equity ratio. What specific steps have they taken?
Well, they secured a renewable credit line with BNP Paribas in late 2024. That's a crucial source of short-term liquidity, like an overdraft facility. More recently, just in July 2025, they announced new credit facilities and a bond issuance program for up to PLN 100 million.
Okay, 100 million bonds. That's significant. What's that earmarked for?
This new capital is specifically earmarked to support the development of these new stationary stores, so it directly funds the physical expansion.
It signals a very clear strategic decision then. Use leverage, use debt to accelerate their expansion plan.
It does. And while this enables rapid growth and, importantly, avoids diluting existing shareholders through issuing new stock,
which investors often dislike.
right. But it also significantly increases their financial risk profile, as we saw with that soaring debt-to-equity ratio. It's a calculated gamble, really.
Yeah.
A gamble on future profitability being strong enough to service that growing debt burden.
Okay, so we have this picture. Huge ambition, hyper-growth on the top line, but also serious financial acrobatics underneath the cash burn, the inventory build, the rising debt. Given all that, how is the market actually pricing Dadalo SA stock? Is the price right in the eyes of investors?
Well, when we look at their valuation, the market is currently assigning a pretty premium valuation to Datalo. They're trading at multiples that clearly reflect very high expectations for future growth and, importantly, future profitability.
Higher than their peers.
Significantly higher.
Yeah.
If we do a relative valuation analysis, comparing Datalo's trading multiples against a carefully selected peer group of other Polish retail and e-commerce companies, we see a really stark contrast.
So the market sees them differently.
Exactly. The market is clearly pricing Datalo not as, say, a traditional retailer with stable but maybe slower growth, but as a high-growth market-disrupting entity.
Can you give us some numbers, like PE ratio?
Sure. Their price-to-earnings, or PE ratio, is currently around 34.2x.
34 times earnings? Wow.
Which means investors are willing to pay over 34 times its current annual earnings per share. Now, compare that to the sector average PE, which is closer to 11.3x, and their specific peer average around 13.3x.
So more than double, almost triple the average valuation based on earnings. What about sales? EV sales?
Similar story there. Their enterprise value to sales, or EV sales ratio, is about 1.7x. Again, that's substantially higher than the 1.0x sector average.
Okay. That premium valuation tells you a lot about investor sentiment, doesn't it?
It really does. It indicates that investors have already priced in a significant amount of future growth and future margin expansion. They're essentially anticipating that Datalo will not only continue its rapid ascent, but will also successfully translate that into substantial and, crucially, sustainable profits down the line.
They're buying the story.
They're buying heavily into the story and the future potential, not just the current financial results, which, as we've seen, are quite mixed below the revenue line.
What specifically is driving that excitement? Why is the market willing to pay such a premium?
Well, the primary driver, without a doubt, is that exceptional top-line growth rate. The market is rewarding the company, quite simply, for its demonstrated ability to rapidly gain market share in a fragmented market, even one that's contracting slightly in units. That's impressive.
And the narrative helps too, presumably.
Absolutely. The compelling narrative of this e-commerce native player disrupting a traditional industry using a superior, integrated, omni-channel model that's highly appealing to growth-oriented investors, people looking for the next big thing, the next market leader. It's a powerful combination. Proven growth plus a forward-looking strategy that really resonates.
Well, but, and this is the crucial point again, this high-flying valuation comes with an inherent fragility, doesn't it? It feels like a house built on very high expectations.
That's exactly the risk. This premium is entirely predicated on the assumption that Datalo will deliver, that they'll continue to grow rapidly and successfully translate that growth into high, stable levels of profitability and, most importantly, consistent positive cash flow.
So what happens if those assumptions don't pan out? If the growth slows or the profits don't materialize as expected?
Any failure to meet these very high expectations could trigger a severe multiple compression. It's often called a D-rating.
Meaning the stock's valuation ratios contract sharply.
Exactly. They could fall quickly to levels more in line with its slower-growing, more traditional peers. We've seen this happen time and time again with high-growth darlings that stumble.
What could trigger such a D-rating for Datalo? What are the specific warning signs?
Well, a few key triggers come to mind. First, a significant slowdown in their year-over-year revenue growth. That would signal that maybe their market share gains are starting to plateau.
Okay, slowing growth. What else? Second, a failure to sustainably improve those gross and operating margins, especially if competitive pressures like that potential price war force them into heavy discounting. If the profitability doesn't follow the sales, the market will notice.
Makes sense. Cash flow.
Persistent negative operating cash flow. If they keep burning cash in their core operations, that signals continued working capital issues and undermines the whole sustainability argument. That would be a major red flag.
And execution. The store's international plans.
Absolutely. Any major setbacks or significant delays in their physical store rollout, or particularly any costly failures in their initial international expansion plans, that could really shatter investor confidence quickly. The market can be incredibly unforgiving when those lofty growth narratives don't materialize as promised. The fall can be fast and hard. Okay, so we've painted the picture. The bullish narrative, the ambitious vision, the premium valuation it currently commands. Now, it's absolutely essential we talk about navigating these crossroads. Specifically, let's really hone in on the key investment risks. While Dadelo's growth story is undoubtedly compelling, exciting even,
It definitely is.
it clearly comes with a commensurate level of risk across operations, financials, the market itself. In your view, boiling it down, what is the single biggest, most immediate risk right now that you, the listener, should be keenly aware of with Dadlo?
Without a shadow of a doubt, the most significant and immediate risk facing the company is inventory and working capital risk.
Back to the inventory again. It really is central, isn't it?
It is absolutely central. That rapid and, as we noted, disproportionate buildup of inventory poses this dual threat. First, it consumes vast amounts of cash, which strains their liquidity and forces them to seek that external financing, like debt. Second, it exposes the company to potentially huge write-downs and margin-crushing discounts if those expected sales don't materialize fast enough.
Like a fashion retailer stuck with last season's clothes.
Exactly that kind of problem. A failure, therefore, to demonstrate clear and sustained improvement in their inventory turnover, basically, how quickly they sell through their stock, is arguably the single greatest threat to Dadelo's financial stability and their future profitability right now. It's number one on the watch list.
Okay, inventory risk, paramount. What else keeps you up at night thinking about Dadelo?
Well, beyond inventory, there's considerable execution risk. You have to remember, the company is trying to simultaneously execute two highly complex and very capital-intensive strategies at the same time.
The nationwide physical store rollout across Poland.
Right, and the planned international expansion starting soon after.
That's a lot to juggle.
It's incredibly difficult. Any significant delays in store openings, major budget overruns on construction or fit-out, or perhaps worst of all, a failure of these expensive new stores to actually achieve their sales and profitability targets. Any of those could lead to significant capital destruction and a major loss of investor confidence. Expanding so quickly on multiple fronts is just inherently risky.
Okay, execution risk. What about the market itself? Competition.
Then there's the pervasive competitive and market risk. The Polish bicycle market, yes, Dadelo is consolidating, but it still remains intensely competitive. And that ongoing threat of a price war, potentially triggered by that influx of discounted inventory from overstocked Western European markets.
That invasion the CEO mentioned.
Right. That could severely impact Dadelo's ability to achieve its target profitability, even if it keeps gaining market share. Remember, selling more bikes doesn't help the bottom line much if you're selling them at razor-thin margins, or even a loss.
True. Profitability matters more than just revenue. And the final big risk category, finance, leverage.
And finally, yes, the financial and leverage risk. Dadelo's increasing reliance on debt to fund its negative operating cash flow and its capital expenditures is rapidly raising its financial leverage.
Right.
We saw that debt-to-equity ratio skyrocket,
Making them more vulnerable.
significantly more vulnerable, to rising interest rates, which makes servicing that debt more expensive, to tightening credit conditions, making it harder to roll over debt or get new loans, or even just to any unexpected downturn in their own business performance. High leverage, simply put, amplifies everything, both gains and losses. It dramatically increases the overall risk profile for investors.
Okay, a formidable list of risks. Inventory, execution, competition, leverage. So for the bullish investment thesis to actually play out, for Dadelo to succeed and justify that premium valuation, what are the absolute critical success factors? What must they achieve, unequivocally, to make that transition from a cash-burning growth phase to a truly self-sustaining, profitable company?
Right. What needs to go right? First and foremost, they absolutely must improve inventory velocity. The company has to demonstrate clear, measurable, sustained improvement in its inventory turnover metrics. They need to prove they can manage their working capital more efficiently and turn goods into cash much faster as they scale up. This is non-negotiable.
Job number one, fix inventory turnover. What's next?
Second, and this is perhaps the ultimate litmus test for their entire business model, they must achieve positive operating cash flow. Consistent organic cash generation coming directly from their core operations would validate their whole strategy. It would prove the model works economically. And crucially, it would significantly reduce their reliance on that external financing, the debt.
Get out of the cash burn cycle.
Exactly. Without positive operating cash flow, they're perpetually vulnerable, always potentially just one loan away from serious trouble.
Okay. Inventory velocity, positive operating cash flow. What's the third critical factor?
And third, they absolutely need to execute profitable retail expansion. Those expensive new physical stores must meet, or ideally, exceed their internal sales and profitability targets. They have to justify the significant capital investment being poured into them and prove the economic viability of the omnichannel model at scale. If those stores become cash drains rather than cash generators, the whole strategy is fundamentally undermined.
So the stores need to pull their weight financially, not just look good.
Precisely. They need to contribute positively to the bottom line and cash flow.
Okay. Those are the keys to success. What about the other side? What are the specific red flags, the potential thesis breakers that you, the listener, should be actively watching out for in their future quarterly reports or announcements? What signals would tell you that maybe the dream is turning into a bit of a nightmare?
A persistent cash burn is the #1 red flag for me. If they fail to reverse that trend of negative operating cash flow within, say, the next 12 to 24 months, that would strongly indicate a structural flaw in the business model that simply isn't fixing itself with scale. Time would be running out.
So the clock is ticking on fixing cash flow. What's another red flag?
Another major red flag would be sustained margin erosion. If we see an inability to defend or ideally expand their gross margins, especially in the face of competition, that would suggest a fundamental lack of pricing power. And that fundamentally undermines their long-term profitability outlook, regardless of sales growth.
Margin pressure. Okay. And the international plans.
And finally, yes, a costly and unsuccessful initial foray into foreign markets through their planned international expansion. If that becomes a significant drain on resources, both financial and managerial, and distracts them from fixing the core issues in their still fragile Polish market, that could be a major thesis breaker too, a bridge too far perhaps.
Got it. Persistent cash burn, margin erosion, a failed international launch. Those are the indicators of genuine trouble brewing.
Those are the big ones to watch for, yes.
Excellent. So to wrap this section up, for your personal dashboard on Dadelo, if you're following this company, what are the absolute key metrics you should monitor in their financial reports? The numbers that really cut through the noise and tell you the real story of what's happening under the surface.
Okay, quick dashboard. I'd say inventory days outstanding, sometimes called days inventory outstanding or DIO, is arguably the most critical operating metric right now. This tells you, on average, how many days it takes for them to sell their inventory. A continued increase would be a major red flag, while stabilization or ideally a steady decline would be a strong positive signal.
Inventory days. Got it. What else?
Of course, cash flow from operations is paramount. Watch for that inflection point, that switch from negative to sustained positive territory. That's huge.
Absolutely. Margins.
Track their gross margin and operating margin percentages closely. Look at the trends quarter over quarter, year over year. Are they defending pricing power? Are they controlling costs as they scale?
Revenue growth still matters too, right?
Yes. Monitor the revenue growth rate itself. Is it still strong, or is it starting to decelerate sharply? A sudden slowdown could put that premium valuation at serious risk.
And finally, the debt.
And finally, keep a very close eye on their leverage. A good metric for this is net debt divided by EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Track the evolution of this ratio to see if their debt is getting out of control relative to their actual earnings power. You want to ensure it remains at a manageable level, especially if interest rates are rising. Hashtag tag outro.
Wow, what a ride, right? We've really gone deep into Dadelo SA today, a company with, undeniably, an innovative omni-channel model, truly impressive top-line growth, and the significant advantage of being backed by an established e-commerce giant like Oponeo.
A lot going for it on the surface, definitely.
But, as we've uncovered, also a company currently walking a very significant financial tightrope, all due to its incredibly aggressive, very cash-intensive expansion strategy. It's a company with absolutely grand ambitions.
Huge ambitions.
But facing the stark, unavoidable realities of funding that growth, the cash flow challenges, the inventory mountain, the rising debt.
It really is a classic example, isn't it? Ambition clashing directly with the cold, hard realities of cash flow and operational efficiency. Dadelo's story offers, I think, a really compelling real-world lesson in modern retail strategy and also in growth investing.
It absolutely does.
So as you, our listener, reflect on this deep dive, maybe consider this. Is Dadelo truly building a sustainable empire here? One destined for long-term dominance in the Polish cycling market and maybe beyond? Or is it more like a high-speed bike race, where the brakes on its cash burn aren't working properly, potentially setting itself up for a really challenging fall?
That's the billions zloty question, isn't it?
It is. What aspect of this whole journey, the rapid growth, the operational leverage, the financial strain, the omni-channel promise, what aspect resonates most with how you view rapid expansion and its inherent risks in today's volatile market?
Definitely food for thought, and certainly something to keep in mind as you look at other growth-focused companies out there, whether they're in retail or tech or any other industry chasing that high-growth dream.
The veterans often repeat
They
themselves.
do. Well, we hope this deep dive has helped you navigate those complex dynamics surrounding DAD.WAR SA and maybe gives you a more informed perspective on the opportunities and the very real risks involved.